A synthetic long future in options is a trading strategy that mimics the payoff of holding a long futures contract using options. This strategy allows traders to benefit from the flexibility and limited risk of options while replicating the payoff of a futures contract. Buy a call option. This gives the right but not the obligation to buy the underlying asset at a specific strike price before the option expires. Sell a put option. This gives the obligation to buy the underlying asset at a specific strike price if the option is exercised by the buyer before it expires. If the price of the underlying asset increases, the call option will gain value and the put option will expire worthless, mimicking the profit of a long futures position. If the price of the underlying asset decreases, the put option will lose value and the call option will expire worthless, mimicking the loss of a long futures position. Let us see an example. Underlying asset, stock XYZ, strike price, $100 expiration date, 3 months from now. By buying a call option with a strike price of $100 and selling a put option with the same strike price and expiration date, you create a position that profits if the price of stock XYZ rises, just like a long futures contract would. This strategy allows traders to benefit from the flexibility and limited risk of options while replicating the payoff of a futures contract. Flexibility, limited risk, and advantages of futures long can be derived. Moreover, the mark-to-market loss is eliminated in synthetic long options, unlike futures where everyday mark-to-market losses need to be paid. When you need help to create a trade setup, WhatsApp me 9494800007